Hi, everybody. So we're going to talk about the home buying process, and let's just get into it here. The first question usually pops up is, do I buy or do I rent? I mean, why is it that we always want to buy? And, sometimes renting makes sense. So let's look at renting. Some of the advantages of renting: you can move in, you can move out, is very simple. Someone else is responsible for the repairs and maintenance. That's a great asset. You don't have to worry about, if your roof has a leak, somebody else is going to fix it. You don't pay property taxes, although technically you might through your rent. You don't have some rentals include at least some utilities like trash pickup and so on that otherwise you'd have to pay as a homeowner. You don't really have any concern about where the housing market is. If it's up, down, or sideways, you don't really care because you're a renter. You avoid homeowners association fees. Renters insurance is pennies on the dollar compared to property owners. But there are some disadvantages, of course, especially if you're an animal lover. It's very frequent and common that you could be in an apartment or a rental situation where the landlord will not allow any pets, or maybe they'll allow a certain pet. Maybe you can have one cat, but what if you want 3 cats or you want a dog and they don't allow that? It's very difficult to personalize your living space because they don't want you painting. They don't want you putting, doing things on their walls, or you certainly can't tear down a wall and put up something else. I mean, you just can't do that. Limited privacy typically in these, although you can also have limited privacy in condominiums and some other home ownership situations, but certainly for a lot of apartments, it's very limited privacy in that. You can't control who moves in next to you or above you or below you, and sometimes they're very noisy. I've had that problem several times. There's no tax advantages. Your rent will definitely be increasing as time goes on. Lots of rules you have to obey. Some landlords don't respond well when there is a problem, and not having your own laundry room, that's problematic as too. So advantages to buying: you can actually make money on the home, right? Because you can see some increase in the value of that property over time. It's easier to predict your expenses because you own that property and you can kind of figure out what your monthly payments will be forever if you have a mortgage. You may have more privacy. You can personalize your space. You could eventually live rent-free or mortgage-free if you pay off your mortgage. Might take you 25 or 30 years, but you could do it eventually. There's some tax advantages to home ownership as well, but that's kind of not as powerful as it used to be. And there is a capital gains exclusion as well, so you can sell your property and not have to claim any capital gains on that. Some disadvantages: you will have an increase in your monthly expenses for sure compared to rent. Usually you will have a larger utility bill. It just costs more money for that. Not as easy to pick up and move. It is a tremendous expense. A big old chunk of your investment could end up in your real estate. And of course, there could be better investments over time. There's no guarantee that your house will ever go up in value. There's no guarantee of that at all. You don't really know what your maintenance costs could be. And typically, if there are maintenance costs, they're pretty substantial for a homeowner. If you have an HOA, then you have to pay for those fees. It's more money for insurance and property taxes as well. So the best rule to go on, do I rent, do I buy, is the 5-year rule. And the 5-year rule very simply states that unless you're going to live in that property for at least 5 consecutive years, then sell or then rent. Because of the costs of getting into a mortgage, the expense of moving, and so on, it really doesn't start paying for itself until you've lived in that home for at least 5 years. So if you can't do that, if you don't know for certain that you'll be there for 5 years, or at least have the assurance that you'll be there for 5 years, then go ahead and rent, because you're going to be moving anyway. Let's see. Already said all that. So how much can you afford? This is the very first step you need to figure out, is how much can I afford to buy? or pay for a mortgage. So do this, and we're going to work backwards from the amount that you can pay to the home that you can actually buy. So yeah, you're going to want to definitely dip into your savings, but you want to deplete your savings fully. So as you know, you should be setting aside money for your down payment and so on in a separate account. And then you need to still have your emergency money, your emergency account set up as well. So here's what we're going to cover on this is figuring out down payment, points and closing costs, mortgage payment, insurance, and maintenance. So starting with the down payment, the more money you can put down, of course, the lower your monthly payment will be. 20% is the typical amount for a traditional mortgage that they ask for. They want to have you provide 20% of the purchase price of the home, and then the mortgage will pick up the 80%. So that will equal a loan to value of 80%, loan to value of the home. The down payment, of course, is your initial equity. So the average home in the Inland Empire is now $530,000. 20% of that would be $106,000. That's your initial down payment, would be $106,000 if you can do that and be at the 20% level. You want to go to Los Angeles, the average home price is $855,000, and 20% of that is $171,000. If you want to go to the Orange County area, the average home price in the Orange County area is $1,165,000, and 20% of that is $233,000. That doesn't mean that you would be spending that much money in the Orange County area. Of course, you might be able to find a very nice home that you like for, $500,000 or $400,000. It just depends, right? But Orange County is very expensive when it comes to homes on average compared to the Inland Empire, obviously. Of course, you could move to Texas. In Texas, you can get a house for 5 horses and 5 cows, which means your 20% down is 1 horse and 1 cow, right? You'd be good to go if you did that. So let's say you don't have 20% to put down. You don't have all these hundreds of thousands of dollars to put into this mortgage. You don't necessarily have to do that. You could put down less, but if you do, then you're going to be required to pay something called a private mortgage insurance, or a PMI, as it's known in the industry. That means that you're paying the insurance to cover in the event that you default. So the mortgage company actually takes out an insurance policy to make sure that you do pay. And if you don't, then the insurance company will pay them. So of course, there's a premium for that, and they pass that cost on to you, the borrower. So that means that you'll have a higher interest rate and you'll have a higher payment because of the PMI that's required. But it does get you into the market. So I would never tell somebody not to do that or to wait until you have the full 20% down, particularly here in California, because of how fast our home prices go up usually. You can typically get out from underneath the PMI in a very short period of time. So PMI runs anywhere from 0.5% to 1%, and then you pay that annually. You pay that as part of your monthly payment. So that's down payment. Let's look at points and closing costs. Points are simply fees that are charged by the lender, generally 1 to 2% of the loan amount. So if you're getting a $500,000 loan, expect to pay somewhere between $5,000 and $10,000 in points or fees. If you don't want to pay points, you say, I don't want to pay any points, you can get a no point loan, but that typically means they're going to increase the interest rate, which means a higher monthly payment. The good thing about points are that they're immediately tax deductible. And so you can do that when you buy your home. So here's just some example of points and other closing costs. So you have, banks will call it a loan origination fee. None of these names actually make any sense. It's just a way for banks to charge you money to get a loan. And for a bank, when they get paid a fee, that fee goes right to their bottom line. It's immediate profit for them. And so they're very fee oriented, most lenders. So a loan origination fee, usually between 0 and 2%. They do an application fee, like you have to pay them to apply for the loan. I don't know, but it's $500. Title search, that just makes sure that you're clear to own the property, that nobody else is on title, that it's your property when you close escrow. That's actually worth the money, 75 bucks or so. Title insurance, again, that's the research into whether or not, title insurance ensures that nobody will come in afterwards and say, no, I own that property. So the title insurance company guarantees your ownership. And again, that's worth it. Appraisal fee, 400 bucks, kind of typical. Doesn't really cost them that much, but there it is. A home inspection, I think we talk about that a little later. Home inspection is definitely worth the money. Credit report, they really rip people off with that, 100 bucks a person. It doesn't cost them anywhere near that, but there it is. And then they throw in miscellaneous for things like doc prep, wire transfer, tax search, that kind of nonsense. So the best thing is to come up with a number, right? Like if you have to estimate about 5% for points and closing costs. So again, now if you're looking at a traditional mortgage of 20% down, you have to add 5% for closing costs. But obviously you want to shop for the best deal. And don't just look at interest rates, look at the whole package. Somebody might charge a lower interest rate, but get you in the fees, right? Stick it to you in the fees. So really shop and pay attention to what they're talking about. So next, mortgage payment. Here's where we come up with a dollar amount for this. So obviously you want to shop for rates. Go to your bank, sure. Go to look at other banks. Use the internet to look these things up. Credit unions are a good source of this kind of money too, because credit unions, a lot of people don't know this, but all credit unions in this country are nonprofit. And so they don't have to charge as much as banks because they're not looking to make a profit per se. They want to make enough money, obviously, but they don't need to make a profit for the shareholders. And then there's outside companies like mortgage companies who, especially when times are good and people are aggressively looking for mortgages, there's investors who want to invest in mortgages, and they'll give that money to a mortgage company who will then make these loans. So you're going to want to use an online calculator or some kind of an amortization schedule to figure out your monthly payment. The online calculators are pretty easy and straightforward to use. This is one that I popped up, took a picture of. So all you would do is fill in these left-hand columns here. So in this case, this is a $700,000 loan, and you're going to put 20% down. So it'll figure the balance based on that amount. And then a 30-year term for this mortgage is very typical, 30-year loan. And interest rates right now, they're fluctuating. They're coming down from where they were, but they're running about 6%. They're running about 6%. They used to be at 3%. Of course, they went, higher after that when inflation kicked in so much. But rates are running about 6%. Actually, when I think they're actually going to be starting to go up again because the Fed just announced a new rate hike, so they might be coming up a little bit more. But 6% as just a number right now, and I put in a zip code so we can figure this out. And this is what comes back out. So you see all this. This tells you what your principal and interest monthly payment is, plus an estimate of your property tax, plus an estimate of your homeowner's insurance. You would add to that a PMI charge if you knew what your PMI charge was, or if you have a homeowners association, you would throw that in here as well. And that'll give you your total monthly payment. This becomes the magic number that we need right here. This is what we're going to base this whole home price on. So this gives us the $700,000 home price, but you can play with this, right? So if that's too much per month, then adjust the home price down or increase the down payment if you can. But you can play with these calculators to come up with a comfortable mortgage payment for you. And then once you have that, then this is the home we're looking for. We're looking for a $700,000 house. That's what we're looking for. And you can see here, it just lays out the purchase price, the down payment, and that provides us the mortgage amount. With a 6% interest rate in 30 years, we have a monthly payment of $33.57 just for principal and interest. That gives us an annual payment of about $40,000 a year if we wanted to buy a $700,000 house and put down 20%. If we want to do less, we buy a $500,000 house, we could get that for about $2,400 a month. And a $300,000 house, you could see, would run you about $1,400. So again, playing with that calculator, you can really zero in on how much you can afford, what's in your budget. What are you comfortable paying? And that should be then backing out from there. You can figure out what your mortgage is, and that'll tell you what kind of a house you're looking for. So monthly mortgage payments cannot exceed, or at least should not exceed, 28% of your gross monthly income. And honestly, lower is better. When you're young and you're just starting out, and maybe this is your first home purchase, yeah, you might want to try to hit that 28% just because you'll probably get a better house for it. Later on, especially when you know your income is going to be going up. Later on, when you're a little more settled in life and you're not really looking, maybe you're looking to move, but if you could keep that payment even lower, it's better for you. Puts more money in other things. So what you would do is take your monthly payment and then divide it by 28%. Take your monthly payment and divide it by 28. So in this case, in order to afford this monthly payment, you would need to be generating monthly income of about $12,000 a month. That's 28% of that payment, which means you'd have to have an annual income of at least $143,000. And you can see again, for $500,000, you need an income a little over $100,000. If you're looking for a $300,000 mortgage, again, traditional $300,000, 20% down, 6%. Those numbers change. All the other numbers change, obviously. But here you could see the annual income needed for that is about $62,000. So that's a pretty wide range. From 700 to 300 is a big range. But start with that calculator. Figure out your monthly mortgage payment that you're comfortable with, or you could just take your income and divide it by 28%. And that'll tell you the maximum payment that you could get approved for. So in this case, if you were making $61,000, the maximum payment that you would be able to get is $1,439 a month. And then you use the calculator to kind of figure out, well, what mortgage can I get for $1,439 a month? It'll help you figure that out. So play with those calculators. Monthly mortgage payment below 28% is something you need to shoot for, but also your debt to income ratio has to be below 38%. So these are the two numbers. You want to write this down because these are the two numbers that they pay attention to. Monthly mortgage payment, just the mortgage itself, has to be 28% of no more than 28% of your income. But your mortgage combined with every other loan you have has to be below 38%. That's the other one. So again, to figure that out, we go like this. That's a good question, Gabriella. These are all gross. This is gross income. We don't need to look at net. We need to look at gross. So debt to income ratio below 38% would look like this. If this is your mortgage and you had $400 in credit cards that you were paying a month, your car loan was $450, student loan of $125, and anything else, threw it all together, let's say it was $3,500, then you take that total debt and divide it by 38%. And that becomes the max that they'll allow you to have, which would be this number here, right? That's 38%. So that means you have to have a monthly income of $92,10 in order to qualify for a $2,398 mortgage. So that's mortgage payment. Let's look at property tax and insurance. Property tax runs about a 1.25% of the purchase price. For some homes, it's a lot of money. I mean, it's a lot of money regardless. But you have to pay it. So you have to figure that in. And then in the insurance side, typically you're going to get a policy that's going to cover you for fire, theft, liability, medical, and others. Shop for the best coverage. Look around. Usually insurance companies will give you a break if you bundle your home with your car. Typically they'll give you a break for that. So you may want to try to present both and get a discount for that. Certainly start with your current insurance agent, but then shop. Make sure you're shopping for that. They won't necessarily tell you this, but one of the things that at least I would suggest you do, is also, and it's optional, you don't have to buy this, but is to buy earthquake insurance. Earthquake is separate, and it's only one group, one company that's authorized to write California earthquake insurance, and that's the California Earthquake Authority. So even though you could get it through your agent is literally just passing the money through to the California Earthquake Authority. That's the actual insurance company. That's the only one that works in California. Why do you want earthquake insurance? Because we live in earthquake country. And if we have a major earthquake and your house is destroyed in the earthquake, even if it's really a fire that takes your house out, the insurance company is going to say the fire wouldn't have started unless you had an earthquake. They're going to point to the earthquake and blame the earthquake. You're not covered unless you have this particular insurance. All right, so just some notes here on insurance. That the costs vary. If your home is near a fire hazard area, it's going to be higher. I live in the foothills. My fire, I have to pay for fire hazard. It's actually hard for me to find insurance because of that. If you want higher liability, it's going to cost you more. And just because they tell you, here's what we'll offer you, that doesn't mean you can't negotiate with the insurance company and request higher coverages. You can do that if you want. You'll pay more, but you might have that peace of mind that you're looking for. Mortgage companies, of course, will require a certain minimum amount because they want to make sure they're protected for the mortgage. And again, it's a little bit less expensive if it's bundled with your auto. Let's look at maintenance, another cost to consider. Varies. If you have an older home, I would expect that you're going to see a higher maintenance expense per month or per year than if you had a newer home. Newer homes, especially if you're buying a home, you can get a warranty for a period of time as well. That might help. But new homes, a brand new home definitely comes with a warranty. But if you're buying an older home, there's definitely going to be things that go wrong. Things always go wrong, right? It's just like owning a car. Anything you own, you're going to have to keep the maintenance up. So always put something in your budget for maintenance. And of course, if you're like a normal person and you're just busy, and you don't have time to do a lot of these things, so you're paying for other people to do your gardening or pool cleaning, or if you have a cleaning service that comes in, those are all additional things that you should put in your budget to make sure you can actually afford the house that you're looking at. So all these things together go into your estimate. And then you want to update your budget to make sure this is actually going to work. Worst thing in the world would be to get all excited, buy the house, move in, and a couple of weeks into it or months into it, you realize, holy smokes, I just don't have enough money. This is way more expensive than I thought it would be. And you would think the mortgage company would go, I'm sorry, you probably wouldn't be able to afford that. No, they won't do that. It's really on us. So be your own best advocate and do your budget. Take a look at it and make sure you can afford it before you get too far. So let's look at some mortgage types. One way to split these up is to look at it as either fixed rate or adjustable rate. With a fixed rate, your payment never changes. For the life of the loan, your payment stays the same. And as we talked about in previous financial literacy seminars, there's something called the time value of money, and there's something else called inflation. And so as we move on through our lives, if you're in this house and 20 years later, or 10 years later even, you're paying for the mortgage the same amount, but it's actually being paid for by cheaper dollars. Because of inflation and the time value of money, you're actually able to pay for your mortgage later on with dollars that are cheaper. So on top of that, hopefully your income's going up at a steady clip. And so eventually, this mortgage that you might have had a difficult time being able to pay for becomes somewhat easier as you move on. That's the hope, at least. And that only happens because the payment's fixed, right? It doesn't vary. You need to have better credit for this than an adjustable rate mortgage. And when available, like we just saw a few months back, when available, you want to lock in a low interest rate. So it's possible you could get in today at 6%, and interest rates drop again at some point to maybe 4%. You would probably want to refinance and lock in at that low rate. I will say that the traditional mortgage rate, if you look at the average mortgage rate over a very long period of time, it actually averages about 9%. So we're still at a relatively low interest rate environment. For mortgages, 30 years and 15-year terms are normal. So 30 or 15-year terms are normal. All right, so $400,000 at 6% for 30 years. It's kind of a minimum of what we were looking at here. This is what that payment looks like over time if it's fixed. So again, the payment doesn't change. You can see here in year one, and every year thereafter for that matter, you're going to pay $28,778 for this mortgage. So your very first year of payments, almost all of that goes to interest. 24,000 goes to interest. Only about 5,000 goes to principal. Why is that? Why isn't it just a steady, so much for interest, so much for principal? The reason is because you're paying interest on the amount of money that you've borrowed, the amount of money you still have left to repay. So your first year, you've got a full $400,000 that you owe, and that $400,000, you have to pay interest on that full amount. As you start to slowly pay back the principal, the interest that can be collected off of that amount comes down, as you can see here. So right about year 20-ish or so, you can see here it starts to cross over the line. So you start to actually make your payment, more money goes towards principal than interest, until you end up at the very, very end of the life of the loan 30 years later, where most of the payment goes towards principal and very little goes towards interest. So that's called an amortization schedule, and that's what they all look like that. They all look like that. So what happens if you refinance? When you refinance, that clock starts all over again, doesn't it? It begins again, that 30-year cycle. So, one of the things you could do if you refinance is, if you're 10 years into your loan, instead of getting a 30-year mortgage, you can get a 20-year mortgage. You also have the initial option of getting a 15-year mortgage instead of a 30-year mortgage, if you want to, at a fixed rate. What happens? One thing is you pay off that loan a lot quicker. The other is you're going to have a much higher monthly mortgage payment. And again, for $400,000 at 6%, the difference is about $1,000 a month. It's about $1,000 a month. So it's not nothing, right? You've got to think about this. Can I really do it? Plus, not to paint too fine of a picture of it, plus, do you really want to pay off your mortgage? And this is a question I know we struggle with. My wife and I talk about this. Do we really want to ever pay off our mortgage? Do we really care? The house is going up in value. That's fine. And, would it be great if I owned my home outright? Sure. But does it really bother me that I have a mortgage on it? I can make the monthly payments. I'm happy. Everything's fine. It's just a debate to have. A lot of people really want to own their home. That's their goal. But if that's not your goal, then you're just looking at monthly mortgage payments. So again, if you wanted to, you could get a 30-year payment schedule and just add to it, right? You could just add additional payments, maybe make an extra payment a year, or pay, instead of paying an extra $1,000 a month, like it would be required in a 15-year amortization, maybe you do $300 a month more. It will bring down it won't change your payment, but it will bring down the time it takes to pay off the loan. The beauty of that is you have the flexibility, right? So if you can't afford the extra payment that particular month, don't make it. You don't have to. It's not a requirement of the loan. It's optional. Of course, the bad side of that is most people will not. Even if they intend to make a bigger payment, they'll find a reason why they shouldn't. Maybe it's, I want to put money into something else or what have you. Again, it's really only for those people who have that desire to pay off the mortgage quicker. So that's fixed rate. Adjustable rate mortgages, or ARMs, the payment will vary depending on the interest rate. This is usually a loan for people who have weaker credit. They can't qualify for a fixed rate loan. It's also very popular when interest rates are really high, because we're looking at still a pretty low interest rate environment here for mortgages. I've been around, I'm old, so I've seen mortgages when they were at 18%, 20%. And at that time, everybody was getting an adjustable rate mortgage because who the heck could afford fixed rate? It was just bloody expensive to do it. You have to be a little careful with adjustable rate mortgages. They do these deceptive teaser rates that make it seem like it's really easy to make that payment. Basically, they want you to get the loan, get in the house, and then when the teaser period is over, all of a sudden, boom, here's this big mortgage payment you have to do. This is not a good mortgage when interest rates are going up. And let's face it, that's the environment we're in right now. So again, I don't really recommend ARMs unless there's no alternative to them. So just as an example, you can see here, you get this introductory rate, which is usually pretty low, and then they have an adjustment period. So some will adjust every 6 months, some will adjust once a year. They usually tie it to the 6-month Treasury security. So when that rate goes up, and it's going up right now, then your rate for your mortgage will follow it. It's tied with that index. They'll add a margin to the index rate of the US Treasury to come up with your rate. And there's usually a maximum rate that they'll set, but it's ridiculously high. They'll also put in a floor to protect, the bank wants to protect itself from rates falling really low. They don't want to follow it all the way down. So they set these rates to their advantage. Trust me, it's to their advantage to do it. Let's talk briefly about FHA and VA loans. The shorthand version of this is, if you qualify for an FHA loan or a veterans loan, look into it. These are really good loans, and they give you some advantages. They give you additional support in applying for a mortgage. So with the FHA, it has to be an owner-occupied property, and I believe you have to live in it for at least a year. It might be longer, but you have to live in that property for a period of time. So it's really meant for owner-occupied property. It's not meant for investments. They only require about 3.5% as a down payment. So you can get into a home a lot quicker because you're only looking at a 3.5% down payment. Sorry, I'm trying to get out of that phone ringing in the background. It also allows you to get into a mortgage if your credit is somewhat weak, if it's not as strong, because the FHA doesn't look for that. The FHA actually has a really low credit score as a minimum. The lender might not accept that. They might have a standard that they need, but it'll definitely be lower than a traditional mortgage. So it's in, again, if your credit is not perfect, if you've got some dings on your credit, an FHA loan may be the way to go. They also allow you to have a higher debt to income ratio. There is some upfront money that you have to pay, and then there's a monthly fee for the mortgage insurance. It's like PMI, right? It's just like paying for a PMI policy. You might get some better interest rates, but I would definitely be shopping around for that. Definitely be shopping around for that. VA loan is somewhat similar in that it's owner occupied only. The VA actually requires no down payment. you know, depending on the lender, depending on the area and what's going on, but the VA does not necessarily require any down payment. So you can get into the loan for 0 down. I mean, that's a heck of a deal. So again, lower credit score, again, you have to check with the lender. They also allow a higher debt to income ratio, and the VA has pretty good rates. VA loans have pretty good rates, so something to look at. Next step, now that you've kind of figured out where your house, how much house you can buy and so on and so forth, next step, get pre-approved. So Equifax, TransUnion, and Experian are the 3 credit agencies that are used by all mortgage companies to pull your credit. When they say pull your credit, it's from one or maybe several of these companies. But these are the 3. Good news about that is once a year, you can look at your own credit report for free. Once a year, you can look at each one of these. Now, just my suggestion is don't look at all 3 at once, because then you're locked out for a year. What would be better is about every 4 months, go in and look at one of them. Wait 4 months, go look at the next one. Wait 4 months, go look at the third one, and then repeat it. So you're looking at this, at your credit report, you know, 3 times a year instead of once a year. And really, they all kind of show the same thing. Equifax, TransUnion, and Experian pretty much mirror each other. So if you're looking at one, you're looking at all of them. And it shows you what's on your credit. It shows you what needs to be fixed. It shows you if there's anything weird going on your credit as well. So do that. How do you do it? You go to www.annualcreditreport.com. And again, once a year, you can look at each one of these. So it's free. Absolutely no reason not to do it. You might also have, you know, a bank that provides you with your credit report. That might be a good indicator as well. But you should definitely still check out annualcreditreport.com. So where are these credit ratings that we talk about? So if you're above 800, that's considered gold. You know, you're just exceptionally good at credit. Honestly, most people under about 40 or so can't get an 800 credit score. It's very difficult for people under 40 to get an 800 credit score, because at least part of that is having a long history of having credit and being able to handle it. So obviously, if you're young, you just can't have that kind of time frame. You haven't had that kind of time frame. You're not going to hit 800. That's okay. Mortgage companies understand that. We would know that going into it. It should be known. If you're 28 or 32 and you're applying for credit, they're not looking for an 800 credit score. But if you're older, yeah, you know, it's definitely better if you have a higher credit score. Very good is anywhere from 740 to 800. That's perfectly acceptable. You know, you're going to get the best rates and terms, or at least most of the best rates and terms. It's good if it's north of 670. It's bad if it's south of 670. If you're south of 670, in fact, 640 is considered suboptimal. But definitely below 670, you're going to start to pay more money. You can have a difficult time getting approved, at least through traditional mortgages. You know, again, the VA and FHA will help. But you're going to have, it's just something you're going to have to pay more money for because of that. There's also on all of these, Experian, Equifax, TransUnion, all of these and other websites can give you some help in how to improve your credit. But the number one way to keep your credit, get your credit to a high level and keep it there, the number one way, pay your bills on time. That's about 38% of your credit rating. Pay your bills on time. Don't have too much credit. Don't use all of the credit that's available to you. These are all ways that really, when it gets down to it, this is how you get a better credit rating.
I had a couple questions in there, Bill.
Okay. You can check your credit report once a month right now because of COVID. I'm not aware of that. That may be true, but I'm not aware of it. Is Credit Karma a reliable credit report monitoring service? It is. I just wonder about the value that you're getting though. If you're using Credit Karma, I don't know what the value of that is, in that you have to pay them for that service. And again, for me, I just check my credit report every 4 months. I go in and look at one of those every 4 months, and that's me looking at it. And of course, I know what I'm looking at. I get that. But what you're looking for is there a lender on there that I've never heard of? Like, I don't have a car loan. And if I looked at my credit report and all of a sudden I have a car loan on there, I'd have issues with that. As it's showing late payments, I've never had a late payment. So if there's a late payment that pops up, I'm going to go, wait a minute, what is that about? Why is there a late payment showing? That's really what you're looking for. And other than that, I don't know what Credit Karma can help you with. I don't know. I think there's probably more to it. That's the thing. So it's really up to you, whether or not you want to be able to, whether or not you can afford it, and if you want to pay the money for that. So getting pre-approved, back to that. Decide on a lender. You're going to do that through the shopping process, right? You're going to look over all the different lenders and what they're charging and what their fees are and their approval process and so on and so forth. Pick one that you're happy with. Go through their approval process. Is there a lot of papers to fill out? Oh my God, yeah. Is there a lot of stuff to provide them? Holy smokes, yeah. Tax returns and W-2s and pay stubs and blah, blah, blah. It's all this junk you have to come up with. But hey, part of the approval process, which is one of the reasons you will end up becoming a very good filer, right? You'll have, if it's electronic, you're going to have little files on your computer that here's where my tax returns go, and here's where my pay stubs go, and here's where my W-2s go. And you can be very good at filing this stuff away so you can get it right away. When you get an approval, it's not a real approval. It's an approval subject to. So the mortgage company will say you're approved subject to the house appraising for the amount that it's being sold for, at least that much. Subject to having a clear title through title insurance. It's subject to approval, the approval subject to having the home inspected and passing the home inspection, right? That's a really important part of it. Then they'll give you a letter. The letter will say you're approved, and that letter is good for 60 to 90 days. If you have an approved mortgage lender, if you're ready to go with a mortgage lender, that helps strengthen your bid for a home. Because now you're going in saying, we're already approved. We like this house. We're ready to go. Here's my approval letter from the mortgage company. That really helps strengthen your bid to get the house. Let's look at types of homes then that are available. The most popular, the highest privacy, the easiest to sell, also the most expensive and the highest maintenance costs are single-family residences. These are homes that have a yard around them, space around them. There's no common walls. That's a single-family residence, or SFR. You can also get a townhome. Townhomes almost always, in fact, I'm just going to say always, have a homeowner association as part of it, because there's common walls and there's common land, right? So you might have a private yard in front, but everything out in front is going to be part of the homeowners association, and that has to be maintained. And because of that, they're going to charge you for it. These also typically come with some amenities to the development. There might be a common pool, might be a tennis court, could be a workout room. It just depends on whatever the developer put in there. But that all has to be paid for as well. So that's part of the HOA. You do have a common wall. If you're the person in the middle, you have two common walls. If you're the one on the end, you have at least one common wall. So look those over. Those are, common townhomes. Condos are usually stacked. So you might have somebody above and below you. You definitely have common walls. Usually less maintenance than a single family residence because of that common sharing of that infrastructure of the building. You, again, as part of the HOA, you're usually getting insurance through the HOA. So the HOA is paying for the structure, the insurance on the structure. You would have to buy insurance for the contents. And again, these developments typically come with amenities. What is often not discussed, but is a perfectly valid option for home is also the mobile home. Mobile home parks, and some are really unbelievably cool. Mobile home parks are also out there. They're way, way, way less expensive than buying a built-in-place home. They usually have less maintenance than a single-family residence, some privacy. You do have to pay the monthly space rental, though. So even though you own the structure, you will not own the property. So you have to pay a monthly fee for the to be able to have the mobile home on that property. That can be quite expensive. So look at that. These are harder to sell. It's not that they're impossible to sell, but they're definitely harder to sell than a single family resident. And again, look for amenities and your property value. This is not the type of home where you would see an increase in the property value typically, because the structure itself is degrading over time. Plus the land, renting the land is definitely going to be going up over time. So you don't see a value increase in that. Next thing to think about is, next thing to think about is a want or a need, when you look at it. When somebody says, I want a pool. Yeah, make sure you understand that's a want, not a need. You don't need a pool. You just want a pool, right? I want 4 bathrooms. Okay. Do you need 4 bathrooms? Is there 6 people living in the house or 2? Why do you need 4 bathrooms, right? Look at what you actually need. What's the minimum you'd be willing to accept? Let's put it that way. Now, maybe you can get more, but at least you want to make sure you're taking care of your needs, right? Do you need a 2-car garage? Do you need a large outdoor living space? These are all things to think about. Everybody's different. And then locations. Every real estate person will tell you this. It's all about location. The smallest house in the best neighborhood is probably got a higher upside potential than the biggest house in the worst neighborhood, right? It's because of location. So what does that look like? Location dictates the value of the real estate. If you want to check that out, drive around those neighborhoods, take a look at them, go to open houses, even if you don't want to buy that house, look at what the neighborhood that has. Get to know the area, get a feel for the prices. Check out Zillow.com. That'll tell you prices in that area. Almost every city has good and bad areas, so look them over, be careful. Check the school district. Number one thing that sells houses and keeps values up is the school district. If you can work your way into a better school district, try to do that. Always work with a real estate agent if you're a buyer. Always work with a real estate agent. Finding a good real estate agent, look for a recommendation, work with somebody, talk to people who have bought in that area that have worked with an agent, see if they're good. Don't use the agent that the seller is using. One agent representing both the seller and the buyer, I would never recommend that. Always have your own agent. They're going to do a better job of negotiating a price for you. Tell your agent the price you want, the neighborhood you're looking for, the type of home, and then your needs and your wants, right? Tell them all of this. Get help. They will help you find that house. They'll help you negotiate. Here's the best part. If you're the buyer, you don't have to pay your agent. Your agent is paid by the seller. When the seller closes the deal, 6% of the sale price of that home goes to the agents, 3% to the selling agent, 3% to the buying agent. So it doesn't cost you anything to work with the real estate agent. My only caveat to that is agents like to upsell you. So if you have a dollar amount in mind, like $400,000, and they pull you up to that very first house and you go, holy smokes, look at this beautiful home. Oh my gosh. Make sure that home is within your budget, because agents will say, well, it's just a little bit more. Don't even look at it. It's like somebody, like, we're going to go car shopping. First car I'm going to show you is a Rolls Royce. I don't care what you end up with. It's not going to be as nice as the Rolls Royce, right? And now you've got this expectation. Wow, look at that. Man, that Rolls Royce, that was such a great car. Same thing with houses. Make sure they only show you houses in your budget, because otherwise it's just really difficult you're disappointed. So no home is perfect. Know that going into it. Be flexible with your needs list. Make sure that you're going to get everything you need, but be flexible. Give the home a good look and bring a tape measure. Like, measure things. If the garage looks a little small, measure it. Make sure that your car will fit. If the second bedroom looks a little small, measure it. What will actually fit in that, right? Take a look at it. So then find a home. Don't fall in love, right? It's just a home. Don't fall in love with it. Help with your agent will help you negotiate the price. You may have to provide a deposit when you put in your offer letter, but they'll work with you on all that. And then go through the home inspection. Home inspection is great because they tell you anything that's wrong with the house before you buy it. Is there mold? That's something the seller will have to fix. I bought a home in San Gabriel years ago, and it was actually I would have never known this. The home inspector told everybody the home is not bolted to the foundation. That's a problem, especially in earthquake country. Little earthquake and the home shifts, falls off of the foundation, I'm screwed. Might as well throw away the house. So what did we do? We went back to the seller. We said, hey, I can't buy the house. It's not bolted to the foundation. They paid for that. And the same with anything else, right? Before you buy, it's better to know, because then you can negotiate with the seller to get that problem fixed. We're kind of running out of time, so I'm going to whip through some of these final steps. When the bank gives you your final approval, you're going to sign all kinds of documents to do that, and boom, there you are. You're now a homeowner. So sorry, I kind of had to wrap up there, but I just want to leave a few minutes here for time for Q&As. So